G'day folks, Jim here from Orchard Forex. It is Saturday the 14th of November. Well, we certainly have a fluid situation in the world right now, and no one can say that we don't live in interesting, if somewhat uncertain times. The key questions on traders' minds seem to be who is actually running the US at the moment. Do we look forward to a COVID vaccine or the second wave of a pandemic? How much can the central banks collectively throw at the economy to restore and underpin global growth? And do we now look at a soft or a hard Brexit in the wake of Friday's firing of the UK Prime Minister's chief Brexit advisor? So all of those things are weighing on traders' minds and certainly giving us plenty of trade opportunities. And I think what we'll do is we'll start off by going and have a look at a big picture of the US dollar. And the chart I've got here at the moment is a monthly chart of the dollar index. And as you can see, this support goes right back to early 2011. And we're sitting right on it, as well as this yellow line here, which is the 100-month moving average. Now, they're providing decent support at the moment. But you have to say the indicators look heavy. And I guess the possibility of a democratic victory in the election, which looks very probable, could weigh on the US dollar. And if that were to be the case, well, we've probably got a fair bit of downside ahead of us. There doesn't seem to be an awful lot of support to me until we sort of get down to this sort of 88.20 level. This is what the 2017-18 low. This level around here, sort of between sort of 90, 91.5. 91 and then down to 90, I guess, will provide some psychological support, but there doesn't seem to be a great deal there. Having said that, if this support holds, then we could see a turn higher again. Personally, I'm pretty neutral on the dollar at the moment. While it does look heavy on the charts, there doesn't seem to be any real reason to me for the euro to start trending higher, sending the US dollar lower. The ECB have already said that they're going to throw all their weapons in the December ECB meeting, which will be on December the 10th, I think, in order to support the European economy. So I think there'll be a huge wave of liquidity going into the EU. So that should prevent the euro from driving too much higher. So all up, I think we're probably in for more choppy trade. This has been going on for 1, 2, 3, 4 or 5 months now, and I think we can probably look for more of the same going into the end of the year and possibly January. While we don't really know what's happening in the States, hopefully that'll clarify itself sooner rather than later, as will the vaccine situation. But until then, I really think we're probably looking at further consolidation. So we go and look at the same chart from the perspective of the euro, and here we have the monthly euro chart, and as you can see, it's almost the mirror image, trying to break up through the resistance, not really succeeding at the moment, sitting right on the 100-month euro moving average. Yes, 100-month euro moving average, but the indicators are beginning to point slightly higher, and if anything, it does look as though the euro could move up a little bit. So coming back to nearer home, this is the daily chart with that trend line we were just looking at, and it's currently sitting just above it, which doesn't really mean much because it's been hovering either side. The indicators are really pretty flat. So like I say, I think for the time being, if you're trading the euro, you probably look to sell it somewhere up here, sort of 119.5, 120, and at the same time, you look to buy it down around sort of 116, 116.50. If we see a break of either side, maybe go with it. But right now, I just suspect we're probably in for further range trading. The currency markets as a whole, to be honest, look pretty choppy. And I think we're probably getting more consolidation through most of the currency pairs. We'll have a quick look at dollar yen. That had a bit of a move lower on Friday. It was unable to hold 105. And having made a new long-term low the previous week, it then rallied very sharply to this 105 3/4 level, 105.60, and it's come back now. It's 104.60. The daily indicators do point slightly higher, but overall, I think dollar yen is going to remain very choppy and basically a hostage to the moves in risk sentiment. So I wouldn't really be getting too involved there. Similarly with sterling, that's quite hard work, obviously because of Brexit mostly. It is trending slowly higher, but that could all change. Now that Dominic Cummings has left the UK government, we might see a softer Brexit, so that could push sterling higher as fears of a hard Brexit towards the end of the, or at the end of the year, fade. But right now, early on, or as we head into the beginning of the week, the indicators are pretty neutral. The dailies not telling us an awful lot either, so I wouldn't get involved there. If anything, the currencies I particularly like at the moment are the Aussie and the Kiwi. The Aussie, it is choppy, and it corrected off this high here from the last week, so the 4-hour indicators have come back to neutral. But the interesting thing about the Aussie and also the Kiwi is, if I blow this up, they both finished above their 200-week moving average on Friday. The Aussie only just, and it has been flitting around with this 200-week moving average for a few months now. The indicators are fairly neutral. The Kiwi is possibly more interesting if we have a look at that. Now, that hasn't been above its 200-week moving average since way back here in 2018, early 2018. So this move might be quite significant, but we are approaching resistance, and as we move towards 70, I think we'll see major selling interest. Once again, the indicator's vaguely positive, so I'd rather be a buyer than a seller, I think. But we are approaching decent resistance, and above there we've also got major FIBO levels as well. So that's something to bear in mind. Nearer home on the Aussie, we did have a bit of a sell-off on Friday, but the daily indicators do point higher. So as long as we stay, I would say now, as long as we stay really above sort of 68, 67 and a half, I prefer to be a buyer of dips. But I'd certainly, if we took out this previous top here, 67 and a quarter, I'd probably be out of it, out of any long positions there, and we're probably just going to see further choppy consolidation. The real action, though, of course, has been in the stock market, so we'll go and have a quick look at the S&P. Okay, so here we have a daily chart of the S&P 500, and as you can see, it actually did make an all-time high early in the week. That was basically on the back of the vaccine news. Since when the market's become somewhat more circumspect, it did finish on a good note on Friday, but basically it's been consolidating sideways. The daily charts are looking to move higher perhaps, but I'm a bit dubious about looking further out, mainly because we do seem to have some, well, for a start we've got major resistance here, which I'll show you. That this goes right back to the monthly charts, but we've also got some kind of bearish divergence building here on the weeklies, the RSIs in particular, stochastics, really running out of steam. So while I remain bullish on the stock markets for the longer term, because I think central banks are just going to throw as much as they can to keep asset prices up, I'm a little bit worried that we might actually see a deeper correction. Having said that, if and when we do, I'd be a buyer of those dips. As long as we go and look at the monthly charts. So here we have this monthly chart going all the way back to 2008, which provides some reasonable resistance, or very strong resistance, and we've come up against it, as well as the monthly charts do look extremely overbought, and once again the RSIs do seem to be running out of steam. So, as I say, while I am bullish longer term, I can see that we might need to have a correction, and that could take several months. As I say, this is a big picture chart, so this isn't nothing is going to resolve itself in the next couple of months, and it may well be that we need to see the new administration firmly in their seat before we see a major move in the markets. But having said that, with the new vaccine, if it does prove to be a winner, the markets could take off really quite sharply. So I do prefer to be long, prefer to buy dips really, but looking eventually for a breakthrough on the top side, but being rather cautious about the overbought status and the bearish divergence seen in the monthly chart. So I would be using trailing stops all the way up. This is a chart of the ASX, which I've really quite liked for some while now, because I kind of thought this was a bull flag, and it does seem as though that might be coming about. So we've had this decent break higher last week. I think it was one of the biggest weeks we've had in many years as far as the upside goes. And if it is going to be a bull flag, we've got plenty of room on the upside to come. So once again, I'm looking to buy dips. I actually prefer this chart to buying the US indices. So the weeklies look positive. The dailies also look positive. So I'm thinking we might see further gains in the coming week. We'll have to see how it goes, but I'm looking to trade that from the long side in the days ahead. One interesting chart that I have been following quite closely is the Shanghai Composite. And rather than buy the US indices, I kind of think that the Shanghai has probably got much more in it. So if your platform allows you to trade the Chinese stock markets, I think it's worth looking at. Whereas the US indices have been making new all-time highs, China's got a long way to catch up. Now this is a monthly chart, so it's big picture again, but it does seem to be building a bull flag. You've got this resistance here going back to these highs, Wednesday, so 2015, 2016. If we break out above this, I think the stock market here will pick up plenty of momentum. So one trade idea that you might have is actually to sell the US indices and to buy the Chinese indices through MT4. It's worth considering because I do think there's probably a fair bit more to go here. At the moment, it's tracking sideways, but as I say, I do like the idea of this being a bull flag with plenty of upside. Targets would be, well, I guess this 3,800 level, and then above that we could go to 4,000, and the 61.8 level is around just over 4,100. So that's something worth looking at there, but it is big picture stuff and it's quite a slow play. Moving forward to commodities, gold I really find is just too hard, frankly. The dailies are pretty neutral. We had this breakout on the top side a couple of days ago, and then we had the $100 an ounce fall. Let's go to the 4-hour chart. We had this $100 an ounce fall, and it's since tried to recover. But as you can see, it's really very choppy. I do think if we see a lower US dollar in time, gold is going to be higher. I don't really see the value in being short golds down here, so I would only trade it from the long side. But having said that, if we look at the weekly charts, they are definitely still headed lower. So it may be that gold just continues to trade this choppy sideways range while these weekly charts unwind. But I just think there's better trades on the market right now. Oil's another commodity that's trapped in this sideways choppy price action. Once again, if we do see a lower dollar, I do think we can head higher, but we have got this significant resistance here in this sort of 43, 44 area, and until that's overcome, I'm not really interested in it. Having said that, if it does go through there, I think we can then sort of head towards 50, perhaps $55. But we get these nasty sell-offs every now and again. It keeps on bounding back, and really the oil price really depends on the outlook for global growth, which comes from whether we find we've got a vaccine or a second wave of the pandemic. So the indicators, the daily indicators, are flat. The weekly indicators equally doing very little. Maybe just trade the range, and right now sort of 38 to 42 would seem to have it covered, so I'd play that range, and in between there I wouldn't really be looking to get too involved. Okay, if we take a brief look at the trends table, which you'll find daily on the website at ultraforex.com, it kind of backs up my views here that the Kiwi looks okay. Although there might be we might get a little bit of a dip on Monday to be able to buy it at a better level. Elsewhere, everything looks pretty choppy right now. The euros, well, the daily charts generally are all turning fairly neutral, indicating that we've got further sideways trade. But as I said just now, it's the stock markets which I kind of like, particularly the ASX, and I think we're going to see higher levels there at some stage soon. The crosses I'd leave right alone because they're just too choppy and they're not really showing us anything at all. So before we wind up, I'll just go and have a quick look at the calendar. So here we have the calendar for the coming week, and as you can see, there's not an awful lot on it. Monday, the Chinese data will be the main highlight, I guess. And there's the RBA Governor Lowe will be speaking, so that might have a bit of an impact on the Aussie. As we move through the week, though, we've got the RBA minutes on Tuesday, another speech with the RBA Assistant Governor Kent, and then we've got there's nothing really until the US retail sales late in the day, and yet more central bank speakers later on. Bailey from the Bank of England, and then we've got various Fed speakers and further Bank of England speakers. Wednesday, more central bank speakers. That's going to be it really for the week. We've got the UK inflation data, which will be important for sterling. And we've also got the EU inflation data out on Wednesday, which comes out at about the same time, a little bit later. And then later still, we've got Canada, which I don't really follow. There's not much from the US on Wednesday. Thursday sees Australian unemployment, and then it all goes pretty quiet really until the US, when we've got the jobless claims and the housing data. Friday, we wind up with the Aussie retail sales. I don't know why they've got the New Zealand general election there, but I think that's been and gone. And we've now got the Australian retail sales, the interest rate setting from China, and that's really about it. It's pretty thin end to the week for the US. So it's all up. I think it's going to be politics and COVID-inspired stories, as well as central bank speakers that are going to provide the direction for the coming week. So we'll leave it there for now. Have a good week's trading, and if there's anything sensational, I'll come back with a midweek video. Cheers.